All right, let's dive right in. We're about to talk about a market so unbelievably vast, it makes the entire global economy look like, well, a rounding error. It's this hidden world of promises and risk, all on a scale that's almost impossible to wrap your head around. Today, we are tackling the $1 quadrillion question.
$1 quadrillion. Yeah, that's a 1 with 15 zeros after it. Just look at that number. This is the estimated size of the global derivatives market. And look, it's a figure so massive, it's kind of hard to even comprehend, right? But that's exactly what we're going to try to do here today, make some sense of it. So to really get a sense of the scale here, just look at these numbers. It's just wild. The derivatives market isn't just big, it's an absolute giant. I mean, it completely dwarfs the value of all the real estate on the planet. It's more than 3 times the world's total debt. And get this, it's nearly 10 times the value of everything the entire planet produces in a single year. That's global GDP.
You want to know another way to think about it? That breaks down to about $190,000 for every single person on Earth. You, me, everyone. That's the sheer scale of this financial superstructure that's been built right on top of our real economy. So the big question is that number even real? Or is it some kind of statistical illusion? Okay, so let's start by peeling back the layers of this absolutely giant number. We've really got to understand what it represents. Is it just a bunch of promises? Or is it actual, tangible risk? All right, and this is maybe the most crucial distinction you need to understand. That quadrillion-dollar figure, that's what's called the notional value. The best way to think about it is like it's the face value of all the bets being placed. But the gross market value, that's what really truly matters in a crisis. That's the actual money at risk, what it would cost to replace every single one of those bets at today's prices. And this right here, this shows you the incredible, almost unbelievable amount of leverage in the system. The actual money at risk is only about 2.5% of that giant headline figure we keep talking about. It means these players can control these massive, massive amounts of economic exposure with just a tiny fraction of the capital. It's wild.
So you might be asking, how does this whole thing not just collapse under its own weight? Well, a key tool is something called netting. It's actually a pretty simple idea. Let's say I owe you $100 and you owe me 90. Well, instead of us both exchanging that cash, we just net it out, and I pay you the $10 difference. Simple, right? Now imagine that across the entire market. This one concept reduces the total credit exposure by over 83%. It's an absolutely critical piece of financial plumbing that keeps the whole system from grinding to a halt.
But what happens when that plumbing breaks? What happens when the system fails? To really understand that, we have to go back in time. We have to look at 2008, when this shadow market was pushed right to its breaking point.
In the fall of 2008, boy, did it reveal the consequences. When Lehman Brothers went down, it wasn't just a bank failure. It was sitting on over 900,000 derivative contracts, worth a staggering $35 trillion. Then, the very next day, AIG was on the brink of collapse. And just like that, suddenly, no one knew who was safe. The trust that holds the entire global financial system together, it just evaporated.
And here's the thing that made it so catastrophic. See, this wasn't like a normal bankruptcy. Lehman's partners could immediately tear up their contracts and just seize whatever collateral they could get their hands on. This sparked an absolute panic, a chaotic rush for the exits that sent these massive shockwaves through the entire system. This wasn't just one bank failing, you see. This was a full-blown contagion that froze the flow of money around the entire globe.
AIG's story is maybe even more direct and, frankly, more shocking. They had this small unit based in London that sold 441 times billion dollars worth of what were basically insurance policies on toxic mortgage debt. And because this part of the business was completely unregulated, they didn't have to hold on to enough capital to actually pay out if things went south. Well, guess what? The housing market collapsed and they got hit with these massive margin calls they had absolutely no way of meeting.
So the government steps in with this massive $180 billion taxpayer bailout. And where did all that money go? Well, this chart tells the whole story. More than half of it, $90 billion, went straight out the back door to pay off AIG's derivatives partners. And many of them were the very same banks that bought the insurance from AIG in the first place. It was just a brutal lesson in how interconnected all this risk really was.
Okay, so the chaos of 2008 obviously forced regulators to do something. Their main goal was to drag this whole derivatives market out of the shadows and, hopefully, build a much safer system.
You know, before the crisis, the market was just this tangled, completely opaque web. Think of it like a black box. Every bank had thousands of private, bilateral deals with every other bank. Absolutely no one had a clear picture of the total risk in the system.
And that meant the failure of just one major firm, like we saw with Lehman, could trigger a completely unstoppable chain reaction.
The new system, on the other hand, is designed to look a lot more like this, what they call a hub-and-spoke model. So instead of everyone trading directly and privately with each other, most standardized trades now have to go through a middleman. This is a central clearinghouse, and it's designed to act as a buffer, a kind of shock absorber for the entire system.
Yeah, this middleman is called a central clearing party, or a CCP for short. And its whole job is to stand in the middle and guarantee the trade. So if one side defaults and can't pay up, the CCP steps in and makes the other side whole. It does this using a giant pool of collateral and capital that it collects from all of its members. The whole idea is to contain a failure before it has a chance to spread.
And believe me, the shift has been absolutely dramatic. Today, thanks to big regulations like Dodd-Frank in the US, over 76% of all interest rate derivatives are now centrally cleared. This isn't some small tweak. This is a massive, fundamental change in the entire architecture of global finance.
But here's the twist. There's always a twist, right? In solving the old problems, it looks like we may have actually created some brand new ones. The system is definitely different, but is it truly safer? Let's take a look at the new concentrated dangers in today's market.
The risks definitely look different now. See, instead of that tangled web of risk, we now have these central clearinghouses, which have become potential single points of failure. I mean, think about it. If one of them failed, the result could be even more catastrophic than Lehman. On top of that, new regulations are making this clearing process more expensive, and the whole market is more concentrated than ever, and just a handful of giant, systemically important banks.
And you know, there's some really fascinating geopolitical shifts happening inside this market too. The US dollar, which has been the undisputed king for so long, is actually seeing its dominance slip. Its share of the interest rate derivatives market has fallen pretty significantly, and meanwhile, the euro's share has actually surged past it. This kind of de-dollarization signals a really major change in the global financial landscape.
And this is where we get to a kind of regulatory paradox. These new Basel III endgame rules are projected to force the big banks to hold over 80% more capital for their client clearing businesses. So in effect, it's like they're taxing the very activity that regulators demanded after 2008 to make the system safer. And the big fear here is that if clearing becomes too expensive, the banks might just, well, stop offering it.
Which brings us right back to our final and biggest question. We took this chaotic, opaque system and we made it more standardized, more transparent. But in doing that, we've concentrated almost all the risk into just a few critical nodes. So the question is, have we actually diffused the financial time bomb that was ticking so loudly back in 2008, or have we just given it a brand new, maybe even more complex timer? That right there is the quadrillion-dollar question that regulators and the markets are still grappling with every single day.